after the recent Berkshire Hathaway annual shareholder meeting, Warren Buffett is again under the spotlight, especially on the shift in his investment strategy. Warren Buffett's Berkshire Hathaway has been aggressively increasing its holding in T-bills, Treasury bills, and decreasing its holding in stocks. As of the end of March 2024, according to company's latest quarterly report, Berkshire held a staggering $153 billion in Treasury bills, showing a sharp increase in from its previous year. Now, what is a Treasury bill? Treasury bill is a Treasury bond that matures under 6 months. So typically 1 month or 3 months or 6 months. Right? So because of that short maturity time, the Treasury bill is usually considered a cash equivalent, right? Because your money won't get stuck in there for too long. Now, right now, the T-bill is yielding around between 5% to 5.5%. If we take the average of 5.3% annual yield for the in the current quarter, it's going to translate to approximately $2.4 billion in interest income for Berkshire Hathaway. And remember, this income is guaranteed and it's free of risk because it's issued by the government of America. So based on the latest reporting of the quarterly result, the total T-bills plus cash equivalent of Berkshire Hathaway is combined to be $189 billion. That's up $21 billion from previous quarter, and it's up $59 billion from a year ago. Now, where is the money come from to buy those Treasury bills? It's actually come from selling Apple stocks. Apple is one of Berkshire's largest and most successful or profitable investment. In the past quarter of 2024 alone, Buffett sold about 116 million shares of Apple. That's about 13% of its stake in Apple. So in terms of dollar value, so if we take the average of Apple's stock price in February, about $187 per share, that's going to be $21 billion, right? That's the same amount of money Buffett put into Treasury bills in the same quarter. So that money comes from selling Apple shares. Now, Apple, after selling significant amount of Apple shares, the stock remains a significant part of Berkshire's portfolio. It's still number one, and it's valued at approximately $135.4 billion as of March 31st. So in the annual shareholder meetings, a lot of questions was asked regarding selling Apple or buying T-bills and the amount of cash Berkshire is holding and how it's going to use its cash. And here are some of the things Warren Buffett said regarding the issue. He said, "I don't think anyone sitting at this table has any idea how to use the cash effectively, and therefore we don't use it." And he has also said, "We'd love to spend the cash, but we don't spend it unless we think we're doing something that has very little risk and can make us a lot of money." Buffett also said, "As the world gets more sophisticated, complicated, and intertwined, more can go wrong, and the company wants to be able to act when that happens." Right? So it's very clear that he wants to hold a portion of its portfolio in cash just in case something goes wrong, like a financial crisis, so he can deploy that cash to pick up some undervalued companies and stocks. So this action of selling Apple stocks and buying T-bills, it's obvious that Warren Buffett is having a cautious outlook on the current market conditions. Now, if we look at this very interesting chart, it's the 20-year chart of Berkshire Hathaway's asset allocation percentage. The green line shows the cash and cash equivalent, including T-bills, as the percentage of total portfolio. Right now, it's at 34%. And the blue line shows the equity security as a percentage of portfolio, like stocks, right? It's currently at 63%. And the red line is the fixed maturity security as a percentage of total portfolio. It's currently only at 3%. So what's very noticeable in the chart is in the past 20 years, the equity security percentage goes up gradually, while the fixed maturity security goes down, which means gradually in the past 20 years, Berkshire is more interested in stocks than the long-term bonds, meaning that overall risk appetite of Berkshire Hathaway actually slowly increased. But what's very interesting for us to look at is the green line. The green line represents cash and cash equivalent, because this is the tool that Warren Buffett uses as a safety margin, and it's where he put his ammunition in to prepare for the next market crash. And by gauging this percentage of its cash and cash equivalent, we can see his take on the market. So very interestingly, the green line throughout the 20 years, it goes in the range of 40% to 20%, okay? And in 2019, when the market crashed, great financial crisis, this percentage was down to 20%, showing that the Berkshire was deploying the cash to buy things, right? And to buy stocks, right? And the stocks were jumping here. And the most recent example in 2021 to 22-ish, that's when the stock market was doing poorly, right? When our rate hike cycle just recently started in 21, right? That the market was performing poorly for the entire year, and well into 2022, right? And we can see Berkshire was deploying cash, and its cash was down to 20% as its total portfolio. So from the chart, right? From the chart, we can see that between 20 and 40, the median number is 30. So we can take 30% cash as a neutral point for Berkshire Hathaway's cash level. So when the cash is above 30%, we can say that Warren Buffett is more risk off, or he's a little bit more concerned. And when the cash is below 30%, it's more risk on, right? He's buying stuff. He's less fearful. And with the current cash and cash equivalent percentage at 34%, it appears that Warren Buffett is a little bit more cautious. So I personally think Warren Buffett's choice makes sense in terms of its cash allocation, because first of all, with the high interest rate currently the Federal Reserve give us, it's very easy actually for us to hold cash or short-term cash investment. Some of the cash fixed income offered in Canada can give you about 5% annual yield. So it's very easy to invest in cash or hold cash. And another reason is actually right now everything is near all-time high again. So it would make sense to be cautious, right? When people are FOMO, smart investors should be a little bit cautious. And the third thing is the monetary policy is so hawkish for U.S. Because in the past 40 years, we rarely see this high of an inflation or this tight of a monetary policy. It suggests that something will go wrong in the future. It's just that people don't know when something is going to go wrong. So it's better to be prepared today, right? So I think I fully agree with Warren Buffett's take on the current market. Thank you very much. Please don't forget to subscribe.